Hey, what's up, stock compounders? Brad here. So, big news today from Chamath Palihapitiya. He just made the biggest investment in climate change that he's ever made. Okay, news out from his Twitter account. The SPAC ACTC announced that it will be merging with Proterra to help make it public. You can see Chamath put down some money through the pipe there. And what is Proterra? Proterra is really an electric vehicle bus original equipment manufacturer, okay? The number one in North America in terms of revenue. And the whole investment thesis for Chamath, it's really based on the company's proprietary technology, the lead they have over other companies in the kind of heavy-duty electric vehicle space. And their revenues, the revenue growth over the last 10 years made this a no-brainer for Chamath. So we'll get in a little bit to this one-pager kind of describing what he sees in this investment. But let's just take a quick look at what the stock did, all right? So it was announced basically this morning that there was going to be this acquisition of Proterra from this SPAC. So yesterday, at the end of the day, the stock was trading at $12.19. You can see right away, before the market even opened this morning, it shot up to almost 2x, finished the day at more than 2x of what it ended at yesterday. So just incredible gains. I think in Robinhood, this company was the biggest gainer of all of the stocks on Robinhood for the last 24 hours. So very impressive stuff. Obviously, the electric vehicle market has just been on a tear. So no huge surprise that this SPAC has done so well on this deal announcement. But you guys are really value investors. That's really who I make content for. So some of you might be thinking, well, what do SPACs have to do with value investing, right? Aren't SPACs just speculative plays where you could lose all your money? So I just want to take a step back, okay? And this is a fantastic kind of write-up about SPACs in Value Investors Club. It was written July 2020, and it kind of highlights, it looks like 6 different SPACs. And I just want to read the first couple paragraphs to kind of frame the case for SPACs as a value investment. So the disclaimer, SPAC is a bit of a dirty word in the value investor community. Very poor performance post-transaction close is well documented, okay? Relative to an IPO, a SPAC enables business owners to sell a greater portion of their business, up to 100% of their business, faster with fewer disclosure requirements and at a lower cost. There is also significant incentive to get a deal, sometimes any deal, done, or the operator/sponsor's investment is lost. Historically, this has not been a winning cohort. However, the lifetime of this trade predates operational risk. So try to throw negative preconceptions out the window. So we're talking about the period of time when a SPAC IPOs until the deal is closed of the announced merger, okay? So we're not holding on to this thing after the deal closes. That's a really important thing to keep in mind. We are only interested in pre-deal SPACs and the attractive risk-reward associated with deal announcement, with retail froth upside and downside mitigated by an arbitrage opportunity, okay? So it's really heads I win, tails I don't lose much, or anything really. So I just want to cover this next paragraph and then we're done with Value Investors Club. What is a SPAC? A SPAC is a public shell which raises capital in an IPO to undertake a to-be-determined transaction, okay? At IPO, SPACs offer units to investors for $10, composed of a common share with varying warrant coverage, which compensates investors for uncertainty associated with the eventual transaction. So there's high uncertainty in these SPACs. IPO proceeds are placed in escrow, typically invested in treasuries, and may only be used to acquire a business or pay out redeeming investors. Sponsors then have typically 24 months of wide discretion to find and execute on a transaction. Investors have the option to redeem their share of NAV in cash at transaction. SPAC units become separable into common shares and warrants after a year. So, it's great. You guys should read this whole thing because it really lays out the investment case for SPACs. Assuming you have a jockey that's fairly reputable, and I don't even know if that's super important. The guy that I got this idea from of this kind of upside without downside using SPACs, I don't think he cares that much about the jockey. He's strictly playing, all right, I can buy this thing for $10. It's worth $10 in cash, and I have this potential upside, okay? Upside without downside. So I want to share one more thing. I heard a podcast from Tobias Carlisle, the Acquirer's Multiple. Many of you have probably heard of him. He runs this podcast. There was a guest recently, Andrew Walker, and he was talking about SPACs on this podcast. It's the most recent episode. A really good episode. I highly recommend it. And he said something really interesting about SPACs in this podcast episode. He said, you buy for $10 a share and you get levered beta times 50 equity upside returns with treasury risk, right? Such minimal downside is his investment case for this, which is really compelling. I like the way he framed that. So, that's the little blurb I want to give on, why as a value investor am I looking at SPACs? So let's take a quick look at, what is the investment thesis according to Chamath Palihapitiya. So essentially, Americans are taking more and more trips on public transportation, primarily buses, okay? Public transportation ridership is increasing faster than U.S. population. There is increasing demand for sustainable transportation solutions. 15 states are targeting 100% zero emissions from medium and heavy-duty trucks by 2050. More than 70% of consumers have changed their behavior out of concern for climate change. Okay, so you guys can read this. I don't need to read everything off here. But it's clear that in the electric bus space, Proterra is the leader in North America. So, that's really the investment case. Revenues are scaling rapidly with 5-year compounded annual growth rates forecasted to be 68%. That is very aggressive. And, take these with a grain of salt. You guys should do your own kind of research and estimating on this. 750 million in current orders and backlog for these electric buses. So then, Chamath came up with an enterprise value, equity value. So this is kind of the quick investment case for Proterra. And of course, you should check out their website. It's pretty slick. Innovating heavy-duty electric transportation from the inside out. Proterra has brought together top electric vehicle engineers and transportation leaders from companies like Tesla, Ford, Bluebird. I wouldn't consider Ford a electric vehicle leader, but GM, BMW, Daimler. Together we have one vision in mind: clean, quiet transportation for all. Now, one question I have, what went into Proterra deciding to go public via this SPAC, special purpose acquisition company, rather than just doing an IPO? That's something I'm quite curious about. Are they hiding something? Did they not want kind of the deep dive that it takes to do an IPO? Did they just need to do it quickly, or was there significant incentive to make this happen quickly for some reason? So that's something I want to understand a little bit better. But it's pretty interesting. Chamath has been talking up this big kind of climate change investment that he's had that he hasn't been able to talk about up until now. So it's interesting to see which company he's pulling the trigger on. Not a surprise that it's in the electric vehicle space. A little bit surprising that it's in the commercial space, but it makes a lot of sense. It's not the sexiest sector within electric vehicles for people to be investing in. Public transportation, but the numbers seem compelling, provided these numbers that Chamath threw out have some substance to, some backing, that they're realistic numbers. And I want to throw out a big caution here, guys. And here's the caution. Doing this strategy, it's great when you take it at face value, right? Upside without downside, if you play this intelligently. But you can get yourself into trouble, and here's how. If you have a few doubles doing this, it's easy to fall into the mindset that investing is easy, that you should be able to double your money very quickly in any market. To me, this is an arbitrage opportunity that probably won't last very long, but seems to be here now, okay? So if a few doubles in a short amount of time is going to make you think it's easy and turn you into a gambler, it's probably not worth even going down this road for you. So you really have to check yourself, right? Check in with yourself to see if you even want to go here, all right? If it's going to kind of tweak your psychology when it comes to investing, stay away. And, that's something I've been searching within myself. I've put some kind of smaller amounts of money to work in SPACs. I actually bought into this one this morning, just a small amount, just to kind of motivate myself to track it and study it. I bought in around here, right when it opened. I think it was like $20.59 or something that I bought in. And I actually sold a little bit at the end of the day. I sold about a quarter of my position. Just so my real strategy with this is, sell off kind of small chunks as it goes up to get back my principal, and then I can let the rest ride if I want to. But I'm kind of following the rule, don't lose money, right? So take, cash in profits until I at least have my principal back. Then I can't lose money. And then whatever happens with the rest, I'm not going to lose sleep over. So that's my strategy, but you really have to check in with yourself to see, if this is a route you want to go down. If this is a route that leads you to, risky options, leverage, margin, all that stuff, you guys, don't go down that road. If you can maintain being rational and being disciplined in this space of SPACs, then I think it's a great opportunity. It's a great opportunity to put your cash to work, potentially in a less risky way than just sitting in cash. And for me, the big thing here, it's really hard for me to sit in cash and wait until an obvious opportunity comes along. So if I can take a small portion of my portfolio and kind of play these games, it keeps me busy. And it prevents me from doing, silly things with bigger chunks of my money. And, that's really how I'm looking at this. It's fun. It's interesting. It's going to kind of keep me busy, but it's not really the thing. I don't think it's something that's really going to move the needle for my portfolio. But I'm intrigued by the idea that it might be less risky than just sitting in cash, which is succumbing to inflation. 3% a year. I think it's going to be significantly higher than 3% a year. So it's a way to make some money kind of on the side with that cash that I'm not using. And if an opportunity comes along, the idea is to buy into SPACs close to that net asset value, where when a great opportunity comes along, I can kind of cash in what I have in these SPACs and deploy it in that great opportunity that comes along. So it's really just a cash alternative at this point for me. But as you can see here, it's a much more exciting cash alternative than something like U.S. Treasuries. You've got the downside protected and clearly a lot of upside potential. So anyway, guys, just wanted to let you know what I've been up to the last couple of days. There's actually another SPAC that I'm digging into. The ticker, I don't even think it's tradable yet. It's going to be out any day now. SWBK, all right? And it's actually the second round of SPACs from this company. And I believe it's also in the kind of alternative energy space. So it'll be interesting to see what happens when that kind of hits the market. Anyway, guys, that's all I wanted to share. Let me know what you guys think of this latest climate change deal from Chamath. And if you guys are investing in any other SPACs, I'm curious to hear from you. I know I bought Bill Ackman's SPAC a couple weeks ago. That's up I think 15% since I bought it. It's starting to get pretty frothy relative to net asset value. So, it's probably one I'm considering cashing out pretty soon, or at least taking some off the table. But yeah, that's what I got, guys. Let me know what you think, you value investors. And it's fine if you want to come at me, if you want to say, hey man, what are you doing? This was a value investing channel. What, you're speculating now? If you want to come at me with all that stuff, let's have a conversation about it. Because I'm willing to be wrong. I'm willing to have to face that there are risks here that I'm not accounting for. So please point those out if you guys see those. And with that, I will leave you guys, and I will see you all in the next video. Take care.